Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. Let's go right to our next guest because we want to talk Apple. The stock is up just about 1% today. It had tumbled over the last couple of days, costing a couple $100 billion in lost market cap since there are some concerns over iPhones in China and all that kind of stuff. So we're going to dig right into it with Dan Ives. He's a managing director, senior equity analyst at WedBush Securities, joining us via the Zoom thing. Hey, Dan, there is some concern here about Apple and the use of Apple products, Apple phones in China. Can you summarize kind of what the issue is and how material of a risk is it at all to you?
I mean, Paul, in my opinion, bark's a lot worse than a bite. I mean, there's essentially been a pseudo ban of government employees for Apple in terms of iPhones the last 2 years. Now, maybe there was a little more restrictions here, but we're still talking about what we believe is 500,000 iPhones max, relative to what we believe is going to be 45 million sold in China in the next year. So, look, I mean, these black swan types of fears of Apple in China just continue to be the issue year after year. But I just believe here, especially when you look at a Huawei phone 2 generations behind, there's no Chinese consumer that, in my opinion, that's, unless they're forced, are buying that over an iPhone.
Still, we saw a huge drop in Apple shares at the beginning of August on iPhone sales slowdown concerns. We kind of ticked back up there, but we're back down near the lows of the year. Not quite there yet. They have a chance to rectify that next week when they come out with new product. Is it going to knock our socks off? Is Paul Sweeney going to go out and buy a new iPhone?
I think Paul Sweeney does buy his new iPhone, in my opinion, because, look, it keeps coming down to, if you look at the chip, you look at the camera technology, combined with the types of promotions we're going to see from carriers, especially in the US, and then you look at 25% of the install base has not upgraded their iPhone in 4+ years. I believe it relates into something where you're going to see actually an uptick in units over iPhone 14. And that's why we're buyers of the stock here, despite haters continuing to hate.
So, Dan, how about pricing? I mean, to be honest with you, I'm probably like a lot of other folks, Dan. I haven't bought an iPhone or upgraded my iPhone in, several years. Talk about the pricing.
You have the 11, right?
Yeah, I have the 11. So they're
coming out with the 15.
So that kind of tells you where it's at. So what kind of pricing power does Apple have in this market, which at least here in the U.S. is, I guess, kind of fully penetrated?
Yeah, I mean, look, we expect for the first time in years, the base prices will be up about $100 when you look at iPhone Pro, as well as on the Pro Max. And this is something where we expect minimal churn because it just keeps coming down to, it is the gold standard phone across the world, which is why I believe, I know you talk about Bloomberg, that I believe at the end of this year, the smartphone leader globally will be Apple. I think they continue to gain more and more share in China. And despite a lot of the noise with Huawei and obviously caught in this cold tech war, it also comes down to just the best phone out there. And I think they're years ahead.
It annoys me when somebody in my group chat has an Android phone.
Oh, I know.
It's the worst.
Yeah.
Green bubble, and then if they like a comment, it sends like a new text. And
yeah, my oldest son is one of those people, and he won't go to iPhone. So of course he's excluded from a lot of our little
exactly.
group things.
Yeah, my dad won't go to iPhone, so we knock him out of the family chats.
Yeah, exactly.
All right, so Dan, Apple, I guess you think is a screaming buy at this level.
I think it's a table pounder, especially what's happened over the last week. And I get it. Bears come out of hibernation mode. Obviously missed a huge run here. This could be it, the quote-unquote black swan moment. We just don't see it. I mean, coming from what we see from a unit perspective, in terms of our trips to Asia over the last, call it 6 to 9 months. So we're buyers here. And I continue to think, as we've talked about, the new tech bull market is here. And I think tech rips into year end.
Hey, Dan, what is... I know Tim Cook was recently over in China trying to work his diplomatic magic here. China, Apple can't escape China, both as a supply chain provider as well as a huge end market. What do you hear from Cupertino as to kind of their longer term strategy about China here? How concerned are they?
Yeah, it's 20% politician, 80% CEO, right? In terms of Cook. And he's been able to navigate China basically as well as anyone out there, obviously along with Musk, in terms of US stalwarts. Look, when you look at Foxconn, the supply chain, I mean, they're essentially the number one employer in China from a private perspective in all of the country, right? So they are so important from a production perspective. But it's a game of high stakes poker. They know they can move things to Vietnam, India. Obviously, that would be painful to do. China obviously is trying to play a poker game as well. But it comes down to the hearts and lungs of the growth story in Cupertino are in China. That's where the share gains have been. And that's why there's so much nervousness over the last week, because this kind of dusts off what's always been that sort of ghost that you're battling when it comes to Apple and China.
I mean, navigating China is pretty easy. You go over there, you kiss the ring, you never say anything bad about China, and you put factories there and employ tens of thousands of people.
That's the strategy, I guess.
I mean, I could do it too. The problem is you have to kind of kowtow to Xi. Does that bite them in the butt at all? I mean, it doesn't seem to have hurt their image in the U.S.
Because it comes down to, you're talking about the biggest technology and consumer brand in the world. And if you like $3,000 iPhones, then we should start producing them in New Jersey.
Yeah.
But if you like $1,000 iPhones, they're going to continue being in China. And look, and it just comes down to like that right now, that web in terms of the supply chain, that's been a huge part of Apple's success. But it goes back to like, from the trillion to 3 trillion, many have just screamed that China was going to continue to be the risk for Apple. But ultimately, it's actually been the trophy case, both from a demand perspective as well as it comes to production. That's why, like, Cupertino continues to play chess, others play checkers. And this is no different. They see these chess moves, and I think we'll navigate it very contained, despite many yelling fire in a crowded theater.
Hey, Dan, 30 seconds left. What's other than Apple, what's your top pick?
I mean, to me, it's Microsoft here because what I view is just the overall cloud and AI opportunity. I think we are now starting to actually see numbers over the next 6-9 months, this AI tidal wave playing out. And of course, Tesla and EVs, that continues to be the play there. So look, this is, in my opinion, it's a fourth industrial revolution playing out in the left lane of technology innovation.
All right, Dan, thanks so much for joining us. Appreciate it. Good luck to those Penn State Nittany Lions as they play the mighty Blue Hens of Delaware. So it's going to be tough. Dan Ives, Managing Director, Senior Equity Analyst for WedBush Securities there.
You're listening to The Team. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
Will Rhind, he's the Chief Executive Officer. He's also talking about Aston Martins, too, so I'm kind of stuck in the middle between these two knuckleheads. He's the Chief Executive Officer at GraniteShares Advisors. We like to talk to Will about ETFs and kind of where is he seeing demand for ETFs. And Will, thanks for joining us here. Appreciate you coming into our Bloomberg Interactive Broker Studio. Single stock ETFs. What are you guys doing with single stock ETFs?
Yeah, this has really been the big growth area for us as a business, but I think a new category for the market, over the last year. So we've just gone through a year of the first single stock ETFs. And very simply, they provide leverage typically, although if you're an inverse one, it's not necessarily leveraged, but they provide exposure to single companies. So very popular companies such as Tesla or Nvidia, and provide people prepackaged leverage to those companies.
And so an example would be GraniteShares 1.5x short TSL daily ETF. What does that do?
Yeah, so that provides 1.5 times short exposure, so leverage short exposure to the daily price of Tesla. And then TSLR, which is the sort of corresponding one, that's the highest leveraged ETF you can get on Tesla, so 1.75 times levered to Tesla.
Wow. I mean, that's a way to play it. So what's the risk to you guys to offering that leverage?
It's not so much a risk to us. I mean, the risk in terms of managing it is really that you get outsized moves clearly because you have leverage. So if the stock price falls, our assets under management fall, and clearly we're levered to the market. So all things being equal, we lose more money. But the idea is that these are very popular trading vehicles. We have NVDL, which has been probably the star of the show this year, which is the 1.5 times leverage in NVIDIA. And so you can imagine since the beginning of the year, people have gotten crazy for anything AI, anything NVIDIA. And the NVDL ETF has just been a rock star for us this year. So I think it's really just a category that's growing, and there's a lot of demand for both the long and the short side with some of these popular names.
How do you?
That's up 392% this year.
Yes.
Only 392%.
Exactly.
On Mondays, I have an ETF show, so I'm looking at ETFs all the time, and
which he gets to leave the show early to go prepare for.
Yeah,
okay,
I have
so
to.
So,
but expense ratios are something I look at quite often, and typically 1.15%, which is what you charge on the short AMD ETF or the NVDL. Typically, that's a relatively high expense ratio. Yeah. But if you're going short, it seems low. How can you afford to charge that when do you need to get the borrow, or how do you structure the trades?
Yeah, so that's in the price, but these are designed to be held for short periods of time, so they're actually super cheap. When you think about it, we have to display an expense ratio just like everybody else on an annual basis. So the actual fee we charge is 99 basis points typically, but that's for if you held it for 365 days. Now, the average person is probably holding these for just a couple of days, or at least a short period of time. So the fee on a prorated basis that they pay is minuscule. And indeed, if people are trading, which you get a lot of these algorithmic traders, quant shops, on the street, they're probably intraday. They pay nothing, just the spread. So it's an incredibly efficient vehicle if you want to trade. And to your point, Matt, I mean, when you look at the shorts, this is incredibly attractive for people because one of the biggest things is majority of people can't go short, number one. But number two, they can't find the borrow. And when they do find the borrow fees for some of these stocks can be incredibly high.
Exactly. Yeah. I'd imagine for Tesla, it's not cheap because it's
cheap.
Probably a popular stock to short.
Exactly. So they can be hugely expensive.
You seem to the thing I like about what you guys do, you seem to find the hot story, like NVIDIA / AI. How quickly can you get an ETF from inception to in the market?
It very much depends. So providing it's following the kind of basic rule set, which is set by the SEC, it's 75 days from when you file the registration statement to getting it out. That's the latest, if you will. I guess they could have technically grant you effectiveness sooner than that. Where you have an issue is when you step outside of that standardized rule set. So, for example, the crypto ETFs or the Bitcoin ETFs that everybody talks about. When you're outside of that standardized rule set, then you could be looking at years to get approval.
Well, do they make it more difficult for leveraged ETFs, for single stock ETFs, for short ETFs? Because those are also, some people might criticize them, especially regulatory watchdogs.
Yeah, no, it's not more difficult because they're in the standardized rule set. And remember, leveraged ETFs have been around for well over a decade. And so you get leveraged ETFs on broad equity indices, on broad fixed income indices, on commodity indices and individual commodities. So single stocks is really just a continuation of an already big and successful category.
What's next for you guys in terms of new ETFs coming?
Yeah, for us, I think more single stock products is where we're seeing the growth, where we're seeing the action in the market. This is almost like a perfect market environment for these products because it's very volatile. People really don't know how to trade this market. In other words, don't have high conviction that the market's going massively up in one direction or massively down in the other direction. So you see a lot of volatility in these names, and that's what traders, active investors really like, and that's why they love these leveraged single stocks.
Does the rising rate environment affect your day-to-day work at all?
For these products, I would have to say it's almost a benefit because people want to try and make more money in a world where the returns by definition are less because of the high rates. So it works well. But for some of our other products, we have income products clear that were, even though our product HIPS, for example, yields about 10% per annum, that was awesome when yields were zero, but now yields are a lot higher. It's sort of cut in half. Now it's still an attractive product. It's just, that's harder environment for those income products.
But it doesn't change like the day-to-day mechanics of creation and redemption.
No.
Interesting. I always find that kind of detail really fascinating because it's something that you don't have to understand to trade ETFs, and most people don't.
Yeah. Well, what it does do, Matt, this is probably a bit of inside baseball, but I do think that the environment for getting seed capital, for bringing ETFs to launch, has gotten harder because seed capital is typically given to you by a third-party firm, typically a market maker or a broker. So their financing costs have gone up. Therefore, the cost of them providing that seed capital to you has gone up. So that makes it more challenging.
How long will you, if you bring a new product to market, it takes a while to get inflows, assets under management. How long will you go before you say, okay, this is a hit or this is a miss and we're going to shut it down?
I think nowadays we're much more ruthless about that than perhaps we were a few years ago. And I think the taboo around shutting products has really gone away. And so that largely
totally
helps
agree.
us.
No one cares. Yeah.
So exactly. So I think a year maximum would probably go before making a call if something's taken or not. And this market, I think, is a good market to do that because people have gotten so used to ETFs that I think you can tell fairly quickly if something's going to take or not.
Yep. All right, hey, Will, thanks so much for joining us again. As always, love checking in with you. Will Rhind, he's the Chief Executive Officer at GraniteShares Advisors, LLC, talking ETFs.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Some M&A news today. Kroger and Albertsons agreed to sell 413 stores to C&S Wholesale Grocers in a divestiture designed to help win antitrust approval for their $24.6 billion merger. Let's break that down with a couple real pros here. Jen Rhee and Jen Bartashus, they're both at Bloomberg Intelligence. Jen Rhee, she covers all the antitrust stuff for Bloomberg Intelligence. Jen Rhee is our retail analyst covering the supermarkets, and they join us here. Jen Rhee, let's start with you here in our Bloomberg Interactive Broker studio. Is this enough for the regulators?
I'm not so sure. I'll say I think this is exactly.
Just take a tough view at these
I
things.
do. I'm just skeptical. Look at what the FTC's been doing for the last couple of years and the line they drew in the sand. When this administration came in, they said, you know what, we're not going to settle deals that have problems anymore because we've been doing that for 40 years and it hasn't worked. It's left us with markets that are too concentrated. So we have to take a different approach. And they've done that. They've taken a different approach, even where companies offer up what I think is a pretty fulsome agreement to settle this matter. But here's the thing. They've been losing in court because the judges look at these divestiture agreements and the commitments that the companies are willing to make, and they say, look, FTC, this is good enough to fix these problems that you've outlined. And I think that's what's going to happen here. I think even if the FTC doesn't like this matter, they think these are groceries, it's food prices, it's sensitive to consumers. We have a problem with this. The chair, Lina Khan, has written extensively about having issues with grocery mergers and thinking they're problematic. But I think when these two companies exactly get that and go into court with this agreement, they have a really good shot at winning in court.
Jen Bartashus, jump in here and tell us what investors' view of this deal is.
Well, obviously, tailing off of what Jen just said, I think ultimately this deal will go through. There are a lot of things that can happen, with a combined Kroger and Albertsons entity that ultimately could be good for the industry. But one of the things I think is interesting about C&S as a buyer in this situation is that their primary business is as a wholesaler. It's not as a retailer. They do own a couple of Grand Union stores, and they own Piggly Wiggly Midwest.
Nice.
But those are largely franchised operations. And when you look at the track record of wholesalers that also operate retail stores, there's not the greatest track record there. So to me, that could be one area where the FTC might push back on C&S as a buyer. only in that, Super Value was a distributor. They sold off the Shoppers chain that they had acquired. United Natural had tried to sell off the residual part of the Cub Foods chain in Chicago, and Spartan Nash only operates a handful of retail stores as well. And so that to me is one potential area of risk, as the FTC evaluates this. Granted, CNS has the balance sheet; they have the strength there to finance such a deal, but they're not actually known as an operator.
Interesting. So, Jen Rhee, would the FTC, do they typically look at who the buyer is and whether that's a good buyer?
Absolutely. That's half of the evaluation. First, the assets to be divested and the buyer. So here's what I have to say about CNS. It does sound like an odd buyer, but this FTC in 2021 approved the merger of Price Chopper and Tops, and they had to divest a number of stores, and the buyer was CNS, and the FTC approved that buyer. Now, right now we have 3 commissioners. 2 of the 3 voted yes on that deal back in 2021. So it seems, at least at that time, they evaluated CNS for that specific deal in those specific stores and found it to be sufficient. I think this is much larger scale. And it also remains to be seen, how did CNS do with those stores that they acquired? The FTC will be looking at that, and they're going to have to show that they were able to be viable competitors.
Hey, Jen Bartashus, talk to us about the supermarket business in general. I mean, again, I'm just amazed that Walmart. Walmart's just the biggest grocery store chain in the U.S. That just kind of blows me away every time you mention that to us. Talk to us about this merger in the context of the industry overall. Is that going to make a big change?
Well, what it does is it takes the number 2 and the number 3 sized retailers and combines them into an entity. A combined Kroger Albertsons gives them a lot more in terms of purchasing power. And theoretically, Walmart does dominate the U.S. grocery landscape by far in terms of market share and in terms of being the largest retailer. So if a combined entity between Albertsons and Kroger can compete more effectively against Walmart, that's actually not a bad thing for the industry as a whole. There has been pushback about the overall consolidation of the industry, but it could actually enable these companies to be even more competitive against the largest player out there.
Paul, have you seen Dope Sick?
No.
Or Painkiller?
No.
These are 2 series, I think Netflix and HBO, I can't remember who. But anyway, they are touching in an extraordinary way. I knew that opioid addiction was a problem, and I've been reading the stories and headlines just like everybody else, but this really hits home when you watch these shows because it's so hardcore. Kroger has agreed to a $1.2 billion settlement for its role in distributing these extremely damaging drugs.
Okay.
Jen Rhee, I was listening to the news this morning, and they said this does not mean that they admit any wrongdoing.
Right.
Have you ever thought to pay $1.2 billion without admitting any wrongdoing? I mean, isn't the payment itself an admission of extreme wrongdoing?
Well, people with common sense and look at these things logically would exactly think that, yes. But technically with settlements, you never have to admit to the wrongdoing. You're saying, hey, it's worth it for us to pay this money just to get this off our back, to move on, to move forward, get rid of litigation, put it behind us. We're putting resources in to defend it, and that's why we've agreed to pay this amount of money.
They're not alone. To me, it's a little shocking because I grew up going Krogering for the best of everything, including the price. I didn't think they were killing everybody in my community. But you know what? Others have also settled. CVS, Walgreens, Walmarts have also entered global settlements of about $13 billion. Jen Bartashus, is this behind us?
I think we've now seen settlements from the biggest players out there. I think that you're still going to see settlements from some of the smaller players that may still filter through. But it does appear at this point that we may have kind of reached that tipping point.
All right, the two Jens, Jen Bartashus, Jen Rhee, thanks so much for joining us here, talking about a lot of things in the supermarket business, M&A, Kroger's, Albertsons, trying to get this deal over the finish line, announcing a divestiture there to do it as well. So we appreciate both of them joining us.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Thinking about these markets, in the early summer, things felt pretty good. Economic growth picking up again, stocks were working, even crypto was working. And then in August, it kind of petered out a little bit. The question is, where do we go from here now that everybody's back in the office? Well, maybe not today, but Callie Cox joins us. She's a U.S. investment analyst at eToro, and of course, she is a proud graduate of the University of North Carolina at Chapel Hill, but we talked to her nonetheless. Callie, thanks so much for joining us via Zoom here. I mean, it kind of felt like August kind of petered out a little bit for some of these risk assets here. What are you telling your clients these days?
Yeah, so first of all, Paul, great football win this past week.
Thank you.
Cheering for Duke always. I totally respect the school unless they're playing us.
Of course, thank you.
But yeah, of course. But turning to August, look across the board, there was a lot of red. And I think it was a case of things got a little too good. Yields started spiking. Everybody thought the economy was coming back. It was coming back. But suddenly inflation worries popped back up again. We are telling customers that there's a lot of pressure on the economy. And really what we're seeing in the inflation picture is higher gas prices. And of course, that's something to pay attention to that can strain consumers' wallets. But is this an inflation crisis like we ran into in 2022? We don't think so.
It is. We are seeing much higher gas prices. I went to fill up this morning and, I think we quote the cash price.
Yeah.
Gas stations will charge you
you're a credit guy.
10. Well, who pays cash for gasoline? Why even have a cash price?
Yep.
Nobody's running around with Franklin's, paying for gas in cash. $3.89 was the regular price I saw today at the pump.
Yep.
But I obviously don't tank the Aston Martin with regular grade gasoline.
No way. You got to go for the premium stuff.
It was like $5.19, the credit price for the premium at a BP.
Yeah, that's nuts.
So you do see pressure on the economy, Callie. Do you see it coming through in the labor market at all? Because it still looks pretty damn good.
It does look pretty damn good, but at the same time, it's weakening, Matt. It's hard to find things to complain about in the job market. Let's be real. I'm watching jobless claims and they are a little bit higher. There has been a bit of a move in the wrong direction or the right direction when you consider the Fed's objectives here. But it's still nowhere near, the amount of jobless claims that we saw at the beginning or, right before recessions in the past. And job data follows that as well. Hiring in the, high 100s was about average in the 2010s. And you have to remember, too, we're dealing with a bigger labor force here. It's tough to look at absolute numbers, but, I'm pretty happy with what we're seeing in the job market, even though there is a lot of pressure and we're seeing wage growth come down as well.
What do we need to see?
We're in that Goldilocks
what
spot.
do we need to see? What does the Fed need to see to cut rates, Callie?
So this is a big, big question right now. And Jay actually told us in July that the Fed would be open to cutting rates if they saw enough progress on inflation. That surprised me because before that, the Fed had tried not to allude to rate cuts, first of all, but it also, talked about rate cuts in a recessionary manner. If we're forced to cut rates because the economy falls off a cliff, then, we'll do it, but don't expect that anytime soon. Powell's tone changed a lot in July. Powell, again, hinted to, cutting rates if inflation made enough progress. Obviously, inflation is moving in the wrong direction right now. Rate cuts still seem far off. One more hike could be on the table, but I think with inflation where it's at right now, that is something we should consider. The fact that, Powell is kind of seeing this risk reward balance even out a little bit.
Callie, how do you guys think about valuation in the stock market here? A lot of folks are telling me, if you pull out the Magnificent Seven, this market's not that expensive here, and you should be looking for some names, maybe some names that have not participated. How do you guys think about valuation?
Yeah, so we actually agree. We don't think valuation is a big risk right now, but you have to dig down to a sector level. If you look at a sector by sector painting, you can see that tech's valuation is, quite high compared to where it was in the past, and also the S&P 500's valuation. I like looking at the valuation of value versus growth. I said value a lot there. The PEs that we're seeing in value versus growth, because value stocks are heavily discounted on a historic perspective relative to growth. And we're pointing that out to customers, saying if interest rates stay high, we could see some opportunities there.
And growth is also already too expensive, right? Or do you see any growth stocks that look attractive?
Growth, I think, again, you have to dig below the surface. I mean, I said tech, tech looks quite expensive. There are different flavors of tech that you have to look at. But there are other growth and rate sensitive sectors that do look a little bit cheaper. Of course, they don't have the profile of tech. But we don't hate going long duration here and, preparing yourself for rates eventually coming down, because again, there's a lot of pressure on the economy. I mean, we know what the Fed is trying to do. So, when we're in this position, when people are worried about rates moving higher, it may make sense to take the contrarian view.
How about energy? Because we've been paying a lot of attention to this move up in oil. We got WTI crude oil up another 1% today to just under $88 per barrel. How do you guys think about the energy space?
Well, if you think inflation is coming back in force, then, it's probably smart to look at energy and those tangible assets and the companies that benefit from the rise in tangible assets. We think this rise in gas prices and oil prices isn't sustainable. We think it's a technical move. We think it's supply driven. So based on that, we wouldn't expect energy stocks to maintain this rally. The question is for how long, though. We think that that's a short-term view, but how long is short-term? We're not sure. We can't predict the day-to-day. But long-term, thinking months, several months down the road, I mean, we don't expect oil prices to keep this up.
You like any risk assets outside of the U.S., Callie? Do you look outside of the U.S.?
I mean, we have U.S.-focused customers, but eToro is a global platform, so of course we look outside the U.S. Globally, I think the rise of the dollar is going to be a huge pressure, especially on emerging markets. And then you see what's happening in China overseas. And, I'll sum it all up with, there's a reason why global stocks are trading at a lower PE than the U.S. right now. Is there value there? I think you have to evaluate it on a country-by-country basis. But, again, there's a reason why global markets are cheap, and it's smart to diversify, but you have to also reckon with, the different situations you're running into.
So within the U.S., are there sectors, Callie, that you like right here?
Yeah, so I think this again depends on timeframes. As long as the economy is chugging along, especially given the pop in growth that we could see this quarter and that we have seen for the past few months, I think some cheaper cyclicals could be an interesting short-term play. However, again, a lot of pressure on the economy. And, if you think that the economy is going into a recession, then, certain sectors like bonds and real estate, for example, could look cheap as well. I mean, right now we're telling customers that portfolio positioning isn't black and white. And there's a big difference between a month from now and a year from now. So, we like long duration here. We like, piling into those rate sensitive sectors. But at the same time, cheaper cyclicals could perform well if we continue to see economic data do well.
Hey, Callie, thanks so much for joining us. Always appreciate getting your thoughts there. Callie Cox, U.S. Investment Analyst at eToro.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's talk about a new IPO potentially coming that's going to be very interesting. Amer Sports, the maker of Wilson tennis rackets and Salomon ski boots. That got my attention.
Dude, I have to say also, my favorite boots and my favorite skis typically are Salomon. They're just like a go-to.
I know. They do good stuff. And tennis rackets, I've had a Wilson tennis racket forever. Bloomberg Intelligence analyst Catherine Lim, she covers all the consumer and technology for Bloomberg Intelligence. She's based in Singapore. I have no idea where she is today, but I see her on the Zoom. I hope she's in Singapore.
Is it Amer Sports, by the way? Is it, I don't Catherine, know. Is it like America? Are they trying to pull a fast one on us, or how do you pronounce it?
Well, you know what? This is a Finnish company. which Sport had actually acquired sometime back in 2019. That's when the deal was concluded. They started initiating the plans to actually acquire this, again, Finnish company that, you've actually mentioned. They've got very well-known brands. Wilson is one, Salomon is one, and actually T-Rex is the one that has actually done exceptionally well in China. And notwithstanding, of course, they actually do have Atomic, which I believe, it is a complete gear.
Also great gear.
Exactly.
Atomic makes my favorite scuba gear, actually. Really? Yeah, they make incredible regulators. High-end equipment.
Yes. So it's a mix of, very well-established brands. And it is interesting to see that they're actually seeking a US IPO and obviously looking to raise funds, which I do believe it is for their expansion both in China as well as overseas.
So, I mean, they've got some competition out there. I just think about the consumer brands, Nike, Adidas, VF Corp. How are they doing in terms of market share?
Did they buy Salomon from Adidas? Because Adidas used to own Salomon.
Right. You know what? That is a very interesting point that you actually raised, because as you may be aware, there's actually an increasing shift towards niche labels out there, particularly by the sports fanatic, who's looking for outdoor gear, outdoor brands itself that goes beyond the North Face or Columbia that, we are familiar with VF. And then, of course, notwithstanding T-Rex. That's actually, I would consider, a higher end brand, and particularly doing actually very well here in Asia. And because of the price points and for the fact that, it is a niche brand, what Sport has actually been doing over the last 4 years since they've actually acquired the company was to slowly but surely expand the merchandise offerings. So we're looking at, more apparels, going into the shoes as well. So expanding the merchandise offerings is definitely a key to actually growing this business.
Catherine, so is the company's pitch here in coming private that, hey, we have some market share gains in China, that's where our growth is? Is that kind of their pitch?
I believe they have their eyes beyond China. And this is really key to establishing, your international brands. So this is going beyond, the Chinese brands that the company had actually made a bit splashed at home with. That's the Sports brand. And let's take a step back. Sports, they made a name for themselves. They've established themselves being now, I believe it is, the 7th or the 8th year to which they are the official sponsors for the Chinese Olympic Committee. So, they are now very well associated among the Chinese, but the company has obviously bigger goals to which they are looking to actually have a portfolio of established labels that goes beyond, your homegrown brands, but the higher pricier brands are T-Rex, Salomon, even Wilson. And I do believe that, they will be rolling out plans for Wilson to be beyond basketballs, rackets that we have seen. They've actually talked about it back in 2019 when they first acquired the company, that they will be looking into apparels for Wilson. Let's see what happens, when Amer makes a successful IPO.
Wilson makes pickleball rackets as well now.
Oh, that's a growth business.
Yeah.
Yet to play
I think
it.
so for sure.
Yet to play it.
I was playing yesterday.
Nice. Hey, Catherine, I'm looking at the, some of the comps and how the stocks have done. I mean, it's kind of all over the board. Adidas is up 37% year to date, but Nike and Under Armour, they're down 15 to 30%. How do the comps look here? How's the valuation here? How do you think this company should be positioned within the group?
Well, I think general sentiment-wise, obviously, we are seeing growing concerns about global demand, the sentiment wise towards the discretionary goods. And that's what you've probably been seeing reflecting in the prices of Nike and VF. Now, Adidas is a bit of a different thing because, again, the company has actually gone through major changes, including a new CEO, and they are actually picking themselves up from what I would say the lows to which, take a step back. Remember last year they lost Easy, the partnership, and then, or rather, they terminated the Easy partnership. They relooked at their inventory situations, and they've actually realigned it along with what they've set themselves going forward. So it's a bit of a different story. It's like a turnaround, if you actually call it. So I think it's very mixed right now. Clearly, there are eyes, and I would say that what we've actually touched on, one of the growth catalysts will surely be coming from China. And, when the sentiment actually turns for China, fingers crossed on that one, you might actually see a more exciting story for Irma.
Interesting stuff.
Yep, very great stuff. I mean, hey, we got an IPO. That's exciting in and of itself. And then when you talk about some of the cool products they have, it makes it even more interesting. Catherine Lim, thanks so much for joining us. Catherine Lim is a senior analyst. She covers the consumer and tech space, and she's head of Asian equities for Bloomberg Intelligence. So we appreciate getting some of her time. She was formerly at Credit Suisse and Citi, so we appreciate that she's now at Bloomberg Intelligence.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It is Friday. It is the time to ask, what is Matt Miller driving? I really don't know. And quite frankly, I'm not really that a super car guy, but our next guest is Michael Dean. He's a senior analyst covering the European automotives for Bloomberg Intelligence. I can't believe we actually pay this guy to do this because we could get it done for free. He would do it. That's
I'm
how much
glad
of a car
we pay
guy he
him
is.
because I think he takes all of his paycheck and buys new cars. Yeah. A lot of people who cover cars don't really care about cars, but Michael Dean does, which is why we love having him on. Michael, I want to get first your thoughts on this beast of a car. I've been talking about it for most of the show already. It's the Aston Martin DBX 707 that I'm lucky enough to test out this week. 697 horsepower, 0 to 60 in 3.1 seconds, even though it weighs 5,000 pounds. What's your take?
Yeah, it's a great car. It sounds good. It's got the performance. So it's the fastest luxury SUV out there. It's even quicker than the Ferrari Purosangue, which is double the price. And it makes up 70% of the mix of DBX sales. So it's a better price point. It's a better car. And it's selling well for Aston Martin.
So I haven't driven the new Ferrari
Yet.
Well, I don't know if I will. That's kind of like a different level. And they're very difficult to get.
Maybe Michael Dean can help you out. Maybe.
Hannah Elliott has... Michael, have you driven the new Ferrari? I don't want to get sidetracked, but...
No, I've been in it. I haven't driven it, but Hannah Elliott has, so we'll have to ask her.
She has like better access than anybody. And she's driven this Aston a few times. I have to say, I absolutely love driving it.
Okay.
Now, it has different modes. You can put it in an all-terrain mode. It has a GT Grand Touring mode. It has Sport and Sport Plus. I think they're useless. You only need Sport Plus. Everything else sucks, and Sport Plus is the greatest experience you could possibly have in an SUV, at least in my experience. But it's frustrating in a number of other ways, Michael. There's no wireless CarPlay, which means I can't use Google Maps. I have to use their extremely dated navigation technology, which just doesn't work that well. If I do want to plug in my iPhone to the Aston Martin, it still has the old clunky USB ports. It doesn't have the new USB-C ports. So I don't have those old plugs anymore at my house. There's no touch screen, right? Now I know these are for most people, it doesn't matter if you buy a car for the engine and to drive it, but honestly on a day-to-day basis, if I'm spending $300,000, I want the best tech. Why can't they deliver it?
Yeah, maybe you're just being fussy, but no, it's true. When the competition has the high tech, so if you look at the Lamborghini Urus, it has a touch screen, it has all the correct interface, it has the connectivity. And what happens is that Aston Martin uses Mercedes technology, but this is the old technology. So you'll have an updated version, probably about 12, 18 months, which will have a flat screen, which will have the connectivity. And also, you'll probably have a plug-in hybrid option. So that is coming, but hopefully that doesn't take away the experience of driving the vehicle.
It doesn't at all, but there's certain... So it has these hydraulic struts in the doors. I've never seen anything like this. You can actually look at them when you open and close the door. We probably have video of it. That's supposed to make the doors, I guess, more comfortable and easy to use. But in fact, they're the hardest doors to open and close that I've experienced in almost any car in the last decade, which is weird. I do like it better than the Lamborghini Urus on almost every level, which says a lot because I'm a huge Lamborghini fanboy, but I think it looks better. It's definitely faster. I think it's more fun to drive. The transmission I like a lot better, which I guess is a Mercedes transmission as well, right? So in terms of the driving experience, I don't know if it can be beat. There's a new challenger in the class, actually a little bit lower, the Porsche Cayenne Turbo Hybrid, which is just coming out, that seems to be, at least on paper, as fast and like half the price. What do you think about that?
Yes, I'm with you. I think Aston Martin is my favorite brand as well, and the drivability is there. But also Porsche ranks pretty high on my best list. And I think the new Porsche Cayenne is an excellent vehicle. It has all the high tech. The engine is fantastic. And it will sell extremely well because it's at a better price point. So, yeah, they're doing well with the new Cayenne. There's no doubt about that.
Aston Martin stock is up 117% year to date. What's going on there?
Yeah, you've got to take into account that it's down almost 90% from when it IPO'd in 2018. So it's had a really tough time since it's come to the stock market. It's got a new set of managers. It's got some new investors. So Lawrence Stroll, he's the main owner. You've had Geely take a 10% stake. You've got the Saudi PIF taking a stake. So they're finally getting it right. They've got new products just being launched. So the new DB12 was launched this month. This is hopefully going to turn around the cash flow to be positive. It hasn't been positive in the years that it's been a listed company. And they have two other vehicles coming fairly soon. So they're on the right path. They've got enough cash to manage certainly for the next 6 to 12 months. And it's getting this free cash flow into positive territory that will be key to them in terms of their performance in the next 12 months or so.
We're showing the video of the car now, or we were for a moment. And if you go to youtube.com and search Bloomberg Radio, you can watch us streaming live. And guys, let's keep showing the video. It's about the car, right? Let's keep showing the car. One of the things that I thought that's a little bit disappointing for a car that, blows me away in almost every aspect from a driving perspective is the boringness of the engine layout. The Lamborghini Urus, the Mercedes AMGs, the Porsche Cayenne Turbo, the Aston Martin DBX, they all have a twin turbo, 4-liter V8. What gives? Why not have a raging V12? In this sense, I think Ferrari tops everybody else, although obviously it's more expensive as well.
Yeah, the V12 6.5 litre that's in the pure same way is a special engine indeed. But the thing is, because Ferrari only makes less than 20,000 cars, it doesn't have to adhere to the same emission regulation that the likes of Porsche and even Lamborghini, because it's part of Volkswagen, has to. So they have the twin turbos to make them more fuel efficient. But hopefully that doesn't take away too much from the enjoyment, at least listening to the engine. I quite like the V8s in those vehicles.
It sounds delicious. In fact...
But we're not going to be able to say that for many more years, are we?
No, we won't.
And I don't know how you car guys, deal with that and accept it.
This is something that I was asking Michael Andretti yesterday. I've asked Lawrence Stroll as well.
Lawrence Stroll is
the owner of Aston Martin.
Aston Martin.
Or at least a huge chunk of it, and he runs their F1 team as well. What do you think, Michael? How does racing and how do luxury cars make this transition? I was test driving the BMW XM a couple of weeks ago, and the sound was really disappointing. And that has a V8, but it's a hybrid.
Yeah, and I'm probably going to disappoint you and also my colleague Kevin Tynan in that I've actually bought a fully electric vehicle. So I've got the BMW iX50, And I've got to say, it's awesome performance. But the one thing that is lacking is the engine noise. And it does make a difference, and it will put people off. The good thing for the luxury car makers, they've got an extended period of grace into which they can phase out their V12s. So the V12s will become V8s, the V8s will become V6s. So we'll still have a ICE, so internal combustion engine, in the luxury brands for many years to come, but they will be electrified in some way. And that's certainly going to happen with the Aston Martin DBX. It's going to happen with the Urus. It's already happened with the Bentayga, and as you mentioned, it's on the Cayenne. So yeah, we're going to have ICE engines for many more years yet for the luxury car makers, I think.
All right, Michael, thanks so much for indulging my partner here in discussion of all things automobiles. Michael Dean, he's a senior analyst covering the European automotives. You mentioned Kevin Tynan. He covers the U.S. companies. They're both super-duper car guys. And
he mentioned the BMW iX, which, again, is on my list.
Is on your list. All right. Michael Dean from Bloomberg Intelligence. We've got somebody in Asia that covers the Asian companies as well. So we've got the global auto business absolutely covered from a Bloomberg Intelligence perspective.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, a real treat here. We're talking serious trading here. Now, we booked this guest to talk about the markets, but quite frankly, we got a lot of markets guests on the week. So let's talk about some real trading in the pits. JJ Kinahan joins us. He's the CEO of IG Group North America. Joins us live here in our Bloomberg Interactive Broker Studios. He is from Chicago, and that kind of goes to the story here. JJ, thanks for coming into the studio here. Chicago Board of Options Exchange, CBOE. What is it, and what did you do there?
So I traded there from 1985 till 2006. And I traded in what, at the time, everything was open outcry, people jumping up and down and yelling. And
That's
screaming.
what this whole hand signals
and all the hand signals, so you'd be someone way across, you'd be checking, check a trade. I bought 20,
right,
paid 30 for it, whatever it may be. And it was a wonderful way to make a living. It was very, at the time, incredibly efficient.
Right.
Obviously, electronic trading is much more efficient, and it's been the greatest thing that's ever happened to retail traders.
Yep.
But there were 550 people in there leaning on each other, spitting on each other, yelling and screaming. It was kind of fun. Even if you didn't know anything, if you didn't like the person you stood next to, you knew everything about them because you stood next to each other for 6.5 hours all day, every day. And I feel very fortunate, Paul, that was part of my background. I met some of the greatest people in the world.
Yep.
And the one thing I will say was the greatest trait there is your word was your bond. If you said buy them, you bought them. If you said sold, you sold them. And if you didn't do that, you were quickly found out an outcast. And so, you think of the millions, hundreds of millions of dollars that went through there every single day, and it went through on people's words. And that was really special.
And so, in Chicago, when I think of some of those, screaming in the pits, I think Chicago. So there's a community there, right? Kind of everybody and that kind of thing.
Yeah, and what's ended up happening is a lot of us have ended up on the retail side in brokerage, and many have ended up still on the trading side with some of the bigger firms. And so it's really helped in terms of the relationships we have. And as we were building, I went on to Thinkorswim at the time. We built that platform. We kind of built it for ourselves.
Yep.
And then, ended up selling it to TD Ameritrade, then started with Tasty Trade, same people who built Thinkorswim to begin with. And so I've been fortunate. I've worked with my friends my whole life.
Right.
I've worked in an industry I absolutely love, and I went from the part of the business where it was all about me to now at Tasty Trade, it's all about helping other people understand the markets and what we did, and it feels really good to do that every single day.
So how do you, all right, so you go from trading in the pits back in the 80s and 90s. How are options and other securities that you deal with, how are they traded these days?
Well, everything's done electronically. So if you put in to buy something, if you went in to buy Apple right now, and the at the money call in Apple, in the front month, you would get filled in, before we could blink our eyes.
Yep.
It's really amazing how quick the electronics work, whereas back when I was in the pit, you might not know what you did for 10 minutes.
Okay.
And that's why they were something called runners. They literally ran back and forth from the pit to the, that's where everyone started. You just ran back and forth all day long. You were in great shape. It was a young man's game at the time.
Exactly, I bet.
But, so I just think that everything that's happened in our business since I started in 85 has been to the benefit of a retail trader. That everything about it has evened the playing field, so that the platforms that we produce today are so much better than anything I ever had in the pit. Mm-hmm. And the information flow now is better for you sitting at home in front of your screen than it is for now. There are still a few pits left. They don't have the information flow you have at home.
All right. So, does that lower the cost for the average investor?
You think about this. Most equity trades are zero now, right?
Yeah, that's
so,
right. Yep.
Think about from that point of view. Again, platforms, the education, we spend, almost 10 hours every single day on our Tasty Live side, broadcasting live about, you guys are doing a lot of news, et cetera.
Yep.
We're doing some of that, but what we're doing more is talking about strategies, about how to learn, about how to think about risk, because the biggest thing that the average person at home doesn't truly understand yet, I shouldn't say doesn't understand yet. Newer people particularly, and as you go up, what I love about the market the most, it humbles, as you know from your background.
Yep.
We started in the business at almost the same time. Is it humbles you every single day, and you can take losing days, you just can't get blown out. And understanding how risk works is the biggest thing the average person has to do if they're going to have success long-term in the markets.
So what is your platform now, IG Group North America? What are you?
So IG is the parent company out of London. We're listed on the London Stock Exchange on our IGG. And Tasty Trade is our brokerage firm in the U.S. And so, at tastytrade.com. And anything I can help anybody with, JJ at tastytrade.com. But, all that, we want to provide, we're kind of a fintech company. We consider ourselves. We build great platforms that incorporate anything a retail trader would need so that they can interact with the markets in a way that hopefully is simple for them to understand. And also, if they want to just trade equities, wonderful. If they want to be somebody who trades futures with options, et cetera, we have the tools for that.
So your audience is primarily retail?
Our audience is 100% retail.
100% retail. Okay. So, but for the institutions, how do they trade? I mean, did they like in my day? If I had to buy 300,000 of Pan Am, I'd go see who owned Pan Am, and I'd start bidding them for it. Now it's. You go to Citadel or you go to some other?
So, it's the Citadels, the Virtus of the world are they have a market-making business.
Yep.
So they'll take the other side of anything anybody wants to do, and they operate on volume and they operate on speed. They provide a very important function for the markets, and I think it's sometimes underrated what the market makers do. Maybe I'm a little biased because I started my career as a market maker, but if somebody wants to come in and sell, you'll buy them. Somebody wants to come in and buy, you'll sell them. And you do that all day, every day. You take advantage of a small spread, which is very small. But outside that, you're putting on positions all day, which help you make money also. Now, when somebody comes in with a big block to buy, they may call around still. That market still exists, because think about it on if you're on an electronic screen and the market, many people see it like 10 by 10, which usually means 1,000 by 1,000, 1,000 to buy, 1,000 to sell, and all of a sudden you see like a 3,000 number up there. Somebody's got 300,000 shares to buy. Obviously, it's going to tilt the market. So that's why when people hear about all the algorithms and stuff, they may say, "Oh my God, that's terrible. They're using them." They actually serve a function, and that is so that firms don't have to necessarily tip their hand when they do have big blocks to buy. They can buy them in smaller amounts without actually making the market go crazy one way or the other.
All right. So if I walked onto a Goldman Sachs trading desk, it wouldn't look anything like back in the day, right?
It still would look like it did. There'd certainly be a lot less people.
Okay.
Absolutely. And the the amount of technology they're using is absolutely amazing.
Yep.
Overall. And back when you were on the desk, you might have had somebody, Paul might have been responsible. I believe you used Pan Am as an example.
Airlines,
for Pan Am or for the airlines, let's say. Now you may have one person in charge of 100 different stocks, et cetera. They're keeping track of everything on there. So we've used technology to the advantage of everyone.
JJ, thanks for coming in. Fascinating.
Thanks. It was a lot of fun.
JJ Kinahan, he's the CEO of IG Group North America, talking a little bit of trading down in the pits. This is Bloomberg.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.